What's the number one thing that could potentially hold up your deal when you're doing a DSCR loan? Is the appraisal. And there's two things that you can avoid or plan for to ensure that appraisal doesn't, one, hold your deal up, and two, kill it. So let's get into it, guys. Welcome back to Chasing Financial Freedom. Ryan DeMint, your host. We're all about DSCR, investment properties, lending, self-directed IRAs, private lending, hard money. But we're talking DSCR loans today, and specifically appraisals. Probably the number one topic that I get from wholesalers and real estate investors are the reason why they don't use a DSCR loan is because of the appraisal. Let's talk about it. From a real estate investor side, one, if you're not paying cash, where else are you going? You're going to go to your local bank or to a bank. Guess what they're going to do? They are going to appraise the property. They are not going to take on a loan without knowing the risk and the value of the property. So either way you do a conventional loan with your bank, you still have to get a appraisal. Two, let's say you actually pay cash. How are you going to evaluate that property? How do you know how much it's worth without getting an appraisal or some type of official record of value? Let's say you buy a property for $100,000 and you fix it up, do everything. You put another $30,000, you're $130,000 into it. Got it. You're 6 months to a year later and you're like, I want to get my cash out. How are you going to get your cash out? Again, two ways. One is a loan. Two, selling the property. So either of those ways, what are they hinged on? An appraisal. Both ways. If you do a cash out, whether it be rate and term, where you're just pulling the cash out that you put into the property, or you want to pull out the full amount up to 80%, you need an appraisal. If you sell the property, more than likely, the end buyer is going to have to get financing. Or let's say they're paying cash. They're still going to want to get an inspection and an appraisal. They want to make sure that they're buying a property at the right value. So if you are just using numbers from a database, from Zillow, from wherever you're using, without actually taking into consideration comps, then you potentially could be in some really deep waters to where you could potentially be upside down on your property. So when I'm working with wholesalers and real estate investors, the number one thing I ask them is, are you guys spot on your numbers? Do you know your market? Do you know the neighborhood? Because I do not know it, and I'm not going to go out and say I do. Let me give you an example. Have a deal that's been dragging on for a while. The appraisals come in $20,000 light. And when you look at the actual comps that the appraiser used on the appraisal report, it's pretty evident that either the homework on comps from the investor side was a little bit off or skewed, or they didn't find these other comps that the actual appraiser found. Now, the appraiser has access to the MLS, and the appraiser has access to government documents, so like the recorder's office and so forth, which we all have access to that. Those are public records other than the MLS. And the closest you can get to the MLS is typically Zillow, but there's also some pay-for-play databases that are out there that will give you comp information. Now, by all means, I am not saying an appraiser is not fallible, because he or she is human. We're all fallible. That's just life in the big city. But when you're off by $20,000, it's a little bit of a stretch. And to not be able to take that in consideration is tough. So they're working through it. We'll see what happens with the end buyer and where it goes. But ultimately, knowing your numbers and understanding what the actual appraiser is going to look at, he or she, they're going to look at comps that are sold in the last 6 months that are less than a mile away. And they're going to try to find properties that are very similar to the subject property. Now, there might be some variances and so forth. And there are some neighborhoods that you really can't find like comps. It's hard, especially in Ohio where I do business. Indiana seems to have some troubles with that. But if you're in neighborhoods that have, let's say, a ton of properties that are owner occupied, and then there's only, let's say, a handful of properties that are rentals, you're going to have a hard time getting that appraisal that you want, that comp challenge to overcome. And I'm stressing, but I'm stretching too, is know your neighborhood. If the neighborhood is full of owner occupied properties and you're going to come in and try to buy a rental, it's going to be pretty hard to get that comp because the appraiser is not going to appraise it based upon owner occupied. They're going to look at it as how much can it be rented for? And that's going to give you the determination for value. If there aren't very many rentals, where do you go with it? Not very many places you can go with it. The other thing, like we talked about earlier, is this. When you're trying to exit out of a cash deal, like I said earlier, 2 options: sell the property, refinance it. Otherwise, how else do you actually get your cash out of your property? Yes, and I understand cash deals close quickly, a matter of days, not weeks. But you still have a hard asset that's worth X amount of dollars that you can't actually liquidate it. So how does that work? And the other thing that comes up every so often is a 1031 exchange, where we're getting investors that are moving those properties from one side of the column to the other to, of course, to protect them from tax liability, which is a great vehicle. But guess what? When they sell it on the front end, it has to be appraised. And then when they go buy a property, it has to be appraised. So you really can't get around the appraisal step. But can you make it less painful? And can you actually make it work for you? Yes. 1, pricing your property correct if you're a wholesaler. 2, if you're a real estate investor, know your neighborhood, understand your comps, understand how many owner-occupied properties you have in your neighborhood on your street, and get an idea of where the actual appraiser is going to go with his or her direction when it comes to the comps in the neighborhood. Because ultimately, they will find those properties that are a close match to your property that are rentals. And if those rentals are not producing the dollar amounts that you're looking for, you're in trouble. And lastly, guys, and I'm going to the third thing because I just briefly mentioned it and I forgot about it before, is this. On the actual appraisal, the appraiser will do a 1007, which is schedule of rents. Now, if this is a refinance and your property's already rented out and you're hitting your rents, God bless you. Good. I'm talking about acquisitions. When there's an acquisition and the property is empty, there's another rabbit hole that you potentially could go down. If you've overestimated your potential rents and you've used that for your DSCR ratio and your rents come in substantially lower, you potentially have killed your deal to where if it falls below a 1.0 DSCR ratio, many lenders will not allow you to do it. And I'll be open and honest with you. I won't let you do a deal at 1.0 for the simple fact, all you're doing is covering your mortgage payment. You're going to have to come out of pocket for property management and any type of maintenance. And then you need to have reserves. Last time I checked, you're getting into this deal so you can actually make money, not actually lose it. And that's where making sure you have your rents lined up, because typically if we have hard comps when it comes to rents and we're off a little bit from the actual 1007, you'll be fine. But if it's a substantial amount off, we can do a reconsideration of value, but those don't get overturned very often unless we have solidified comps that the appraiser can look at and see and know exactly what's going on. So dialing in your rents is another huge piece of the actual appraisal process. And I'll drop one more thing. Appraisals do typically take anywhere between 5 and 10 business days, but ultimately dial in your neighborhood. Understand where your comps are at, how old they are, and are they owner occupied or not. Dial in your rents. Make sure your rents are on par with the actual neighborhood. If it's an acquisition and it's empty, make sure you got it tight. If it's an acquisition, it's already being rented out and it's above rents, God bless you, that's a good thing. If it's an acquisition, a cash out refi or just a rate and term and you've already got it rented out, you're good. Understand the shifting market. Understand where rents are going in that local neighborhood or that actual street, and know where the direction of the overall market is going, because that is going to affect your appraisal. All right, guys, hope you guys found this video helpful. Please subscribe and share. I'm here to build community. Look forward to talking to you guys on the other side. Stay safe, stay healthy. I'll see you guys on the other side.